My next guest expects banks to lobby the regulators aggressively on the rules and also help reduce the bill's effectiveness in preventing future financial crises. We welcome Marty Fridson. He is a global credit strategist at BNP Asset Management. Marty, you've got a long history in the financial industry, high yield, as well as what's going on right now in banking reform. Do you think that the guts of the bill that you've seen, is it really going to prevent the next crisis?
No, I don't think it really will, even in full force. And unfortunately, it's been estimated that about 75% of what's in the bill is really still up for grabs because it's left to rule setting by the regulators. And you can count on the banks to be lobbying very aggressively. And my concern there is who's going to be lobbying on the other side. In the case of the consumer protection provisions, there are organized lobbies, but there really isn't a lobby for financial stability. It's unfortunate because we all have a stake in it, but it's a really difficult issue to mobilize people around.
You only get lobbies for financial stability when you have instability in the marketplace.
Well, that's right. I think when you have a crisis, people get very focused on it. There's a lot of concern and efforts to put in measures that will prevent a recurrence. But once the crisis has faded, it's understandable that Congress and the attention of the public goes on to other issues. And that gives an opportunity for the industry to chip away, as they have after previous financial reforms, to chip away, kind of loosen up the rules on the premise that, oh, these are archaic, outdated rules. It's costing us jobs. And, of course, the worst thing that could happen is this would all move overseas, and we'd lose our position in the financial markets. And in light of some of the things that have happened, that might have been a good thing.
Do you think that that's really likely, though? I mean, do you think that that's an argument that really holds water?
Well, I think it's overstated. There's always the specter of the jobs going overseas, but other countries are worried about those same kinds of issues. There is some effort to cooperate rather than to compete in a race to the bottom. I don't think we can be completely complacent. We do want to maintain a good marketplace and have the flexibility to be innovative, but I think that you do get into the problem of holding up this specter of the loss of the market, even when it isn't really protecting ideas that do have genuine merit for the economy.
Tell us about the marketplace right now for high yield debt, because there's a sort of schedule of, issuing high yield debt, but people have to make sure that when they issue it, someone's going to buy it. Are there a lot of investors out there trying to buy up high yield debt issues?
Yes, there are. They're not chasing it. Right now, I would say that the values are pretty good if you look at a one-year horizon in terms of where we're likely to go with default rates and spreads. The risk premiums on the high-yield bonds. But investors are worried. I think the picture has worsened somewhat on the economic outlook, so that's created greater uncertainty. So there are buyers, certainly at lower prices and for the better quality paper, but they're not chasing after the bottom of the barrel types of issues, and they're willing to fill their needs in the new issue market as those deals come.
Are those deals coming? I mean, are companies still robust in issuing high yield debt?
Yeah, there's still a lot of desire to refinance. There's not a lot of capital spending or needs for expansion capital, but companies do want to push out their debt maturities further. You continue to hear about the wall of maturities, the concern that...
What does that mean, the wall of maturities?
Well, the debt that was issued in the mid part of the decade under very good conditions, very favorable conditions, and with the support of a lot of collateralized loan obligations, a lot of that will be coming due, not this year or next year, but as we start to go out a little further. And the collateralized loan obligations have mostly vanished from the scene. So there's some concern about the ability of the markets to replace that debt. So rather than take their chance of being there, waiting to find out what happens when they get there, companies would like to refinance now and extend those maturities out to a point where they'll feel safer, that they won't be in that crunch out 2 or 3 years from now.
Should we feel safer because that's all happening right now?
Well, it's done a lot of good already. A lot of maturities that would have been due this year or in 2011 have already been pushed out, and that definitely increases the predictability and the likely liquidity of the market. So, yeah, to the extent that they can continue to finance out, that's paving the way toward a healthier market going forward.
All right. I want to thank you very much, Martin Fridson, coming to us as the chief credit analyst, strategist at BNP Paribas. Appreciate your insight into high yield and also financial regulatory reform.